Welcome back, traders. In our previous videos, we introduced you to CFDs and walked you through how they work. Today we're going to tackle three crucial concepts in CFD trading: leverage, margin, and spread. Understanding these elements is key to managing your risk and making informed trading decisions. Let's break them down. First, let's talk about leverage. Leverage is essentially a loan provided by your broker that allows you to control a larger position in the market with a relatively small amount of your own money. It's often described as trading on margin because you're using borrowed funds to increase your potential returns. For example, if you have $1,000 in your trading account and your broker offers 10-to-1 leverage, you can control a position worth $10,000. This means that a 1% move in the market can result in a 10% change in your account balance. Leverage magnifies both your potential profits and your potential losses, so it's a double-edged sword. Here's an example. Imagine you're trading a CFD on a stock priced at $100, using 10-to-1 leverage. You buy 100 shares controlling a $10,000 position with just $1,000 of your own money. If the stock price rises by 5% to $105, your position is now worth $10,500, giving you a $500 profit. Without leverage, that 5% gain would have only netted you $50. But remember, if the stock price drops by 5%, you'd also lose $500, which is a substantial part of your initial $1,000 investment. Next up is margin. Margin is the amount of money you need to deposit with your broker to open and maintain a leveraged position. It's a fraction of the total trade size and serves as a good faith deposit to cover potential losses. There are two main types of margin you need to be aware of. One, initial margin. This is the amount required to open a new position. It's typically expressed as a percentage of the total trade value. For example, if the initial margin requirement is 5% and you want to open a $10,000 position, you'd need to deposit $500. Two, maintenance margin. Once your position is open, your broker may require you to maintain a certain margin level. If your account balance falls below this level due to market movements, you might receive a margin call. This means you'll need to deposit more funds to keep your position open, or your broker may close it to limit further losses. Imagine your initial margin requirement is 10%, and you've opened a $10,000 position with a $1,000 deposit. If the market moves against you and your losses bring your account balance below the maintenance margin level, say $700, your broker may issue a margin call. You'll need to deposit more funds to bring your account back to the required level, or your position could be closed automatically. Finally, let's discuss the spread. The spread is the difference between the buy price, also known as the ask price, and the sell price, also known as the bid price, of a CFD. It's essentially the cost of making a trade and is how brokers make their money. For example, if the bid price of a stock is $100 and the ask price is $101, the spread is $1. This means that as soon as you enter a trade, you're down by the spread amount. To make a profit, the market needs to move in your favor by more than the spread. Let's say you buy a CFD on a stock with a spread of $1. If the stock is trading at $100, you might buy at $101. For you to start making a profit, the price needs to rise above $101, covering the spread and any other costs associated with the trade. Now let's put it all together with a practical example. Imagine you want to trade a CFD on gold. The current price is $1,800 per ounce, and the spread is $1. You decide to buy 10 ounces using 10-to-1 leverage. Your broker requires an initial margin of 10%, so you deposit $180 to open a $1,800 position. Since the spread is $1, you're effectively starting your trade at $1,801. If the price of gold rises to $1,810, your position would be worth $1,810 per ounce. After covering the spread, you'd make a $90 profit on the trade, which is $10 per ounce times 10 ounces minus the $10 spread cost. But if the price drops to $1,790, you'd be at a loss. And if your account balance falls below the maintenance margin, you could face a margin call or have your position closed. So that's a deep dive into leverage, margin, and spread. Three key components of CFD trading that you need to understand to trade effectively and manage your risk. In our next video, We'll explore the different types of CFDs and the markets you can trade in. So be sure to subscribe and hit the notification bell to stay updated. If you found this video helpful, please give it a thumbs up and share it with others who might benefit. And as always, leave your questions and comments below. I'm here to help. Thanks for watching, and I'll see you in the next video.